Welcome to Checklist for Survival, a series of videos produced by John Stewart, president of QP Consulting, Inc. John Stewart is also co-author, along with fellow industry consultant Larry Hunt, of a book titled Print Shop for Sale. This book has been used by thousands of print shop owners, both independent and franchise, as well as franchisors and business brokers, to calculate the value of a printing business. Print Shop for Sale is available through John's website at www.quickconsultant.com. The book offers a step-by-step guide for establishing a fair market value for a printing firm, whether you are a seller or the buyer. This video, titled A Real-World Valuation, takes some of the information provided in Video 5 and demonstrates how the excess earnings formula can be used to value a printing firm with $1 million in annual sales. Today's video will take a look at some of the key ratios and numbers for a company named Premier Digital and demonstrate how we arrived at the value for this firm. Now, let's join John Stewart as he discusses some of the key aspects of valuing a printing business.
Good morning, everyone, or at least it's morning here in Florida, and welcome to my second video on valuing a firm. Before I get into the meat of this one, I want to return very shortly, very briefly, to a slide in the last presentation, and that goes over our basic valuation formula. I want to emphasize the importance of calculating a business value and how dependent it is upon calculating an accurate excess earnings figure. Excess earnings is calculated by taking our total owner's compensation, which we've already discussed how to calculate that, less a fair market salary for the owner. We already discussed that. That's $14,000 plus 4% of sales, and that total amount marked up by 18%. From that calculation, we need to do one more thing. We need to subtract from it 10% of the net assets that you intend to sell with this business. Once we've done that, we end up with what we term excess earnings. Excess earnings is then subjected to a multiplier, and we take that amount, add that to the net assets, and come up with a value for that printing firm. Now we're going to move on to our second slide in this presentation, and we've discussed this in the prior one as well, on establishing a fair market salary for a single owner. Basically, once again, to stress the fact, our formula says it is $14,000 plus 4% of sales, all of that multiplied times 1.18 to take care of all the fringes and costs and benefits that an owner receives or is entitled to or is paid on his behalf. So with that said, we're then going to move on to the next factor. Our formula, the next element in our basic formula says that once we've established excess earnings, and in the prior video we went over that, and we stress how important it is for you to calculate one owner's compensation, subtract from it that fair market salary, subtract from that, once again, 10% of your net assets. Now we have the final true excess earnings of the company. And we are going to multiply that times what we consider an excess earnings multiplier. I'm going to demonstrate real quickly how we arrive at this multiplier. And we start by using a two-page questionnaire, which is available on my website. The basic questionnaire is, and it's self-scored. You score this questionnaire, and ultimately at the very end, we end up with a multiplier. Now let me bring that slide up for a second so I can just go over a couple of the questions just as examples. Once we have determined our final excess earnings number, we're going to subject that to a multiplier. Well, how is this multiplier calculated? Well, in fact, this was the biggest challenge when Larry Hunt and I wrote Print Shop for Sale. We needed to go over and calculate how we determine an excess earnings multiplier. In the past, in most business valuations, quite honestly, appraisers, people doing valuations, almost pull numbers out of the air. Or they'll look at a book, they'll pull a book up on valuations, they'll check a specific industry like printing, and it would show some range of 2.5 to 3.5 or something like that. And you always wondered, where did that multiplier come from? Inherently, in the theory, the lower the multiplier, the higher the risk. The higher the multiplier, the lower the risk. But we thought that was awfully general. And in fact, in too many cases, too many valuations, in the end, you have an excess earnings subjected to a multiplier, but actually not just one, but a range from a multiplier of 3 and a multiplier of 4. And so the appraiser would end up giving you a value of the firm. Well, it may be valued between $500,000 and $700,000. Well, that wasn't good enough for Larry Hunt and I, so we worked on this questionnaire. We developed 14 key questions for measuring the success or failure of a printing firm in this industry. The questions are weighted differently, are scored differently, and in the end, we have 14 questions, we have 14 scores, and we end up with a multiplier. Now, this valuation questionnaire is available on my website. I want to show you just quickly. This is page 1 of page 2 of the questionnaire, and by scoring on this questionnaire, you end up with a multiplier somewhere between 2 and 6.3. Most of the companies that I end up valuing, that I have valued in the past 2 to 3 years, have received a multiplier of anywhere from a low of 3 on up to maybe 5.2, 5.3. It's almost impossible to get a perfect score on these multipliers. The questions, just to give you a brief example, the questions will involve company history and age, rating of the current location, current facility analysis, strength of customer base. That's an interesting question, by the way. I just did a valuation, or actually just talked to an owner. Probably won't do the valuation because she got so discouraged after I talked to her on the phone. But she's trying to sell a $300,000 company, and one customer represents 80% of those total sales. That's $270,000. Well, the first question would be, is there even a contract with this key customer? You lose that customer, you've lost the business. Well, no, there was no contract. Even with a contract, that would be a very questionable purchase, to purchase a company where 80% of its sales was one customer. But anyway, we're going to move on from that, and now we're going to move on to what I consider a very, very interesting analysis, and that's, we're going to take a company called Premier Digital Printing, or Premier Printing, and we're going to give you the solid numbers for that company and take those numbers and then move on to a final value of that company. First of all, as you're going to see on this slide, and I'm going to pull it up on the iPad right now, we've got a company doing $980,000 in sales, and in total sales. By the way, their total net assets, that's the equipment, furniture, and fixtures, the fair market value of those assets that you're going to be selling. By the way, you're going to be selling them free and clear. So if you owe any money, you're going to have to pay that equipment off before you sell it. We've calculated an owner's compensation of $138,320. We've got a fair market salary based on that formula that we've discussed before. It turns out that the fair market salary calculation would be $63,600. We then end up with an excess earnings of $53,375. That's going to be a critical number in our formula. This $53,375, our value of the net assets of $213,000. Those are the two critical numbers. The last number that we've already discussed is the earnings multiple, the excess earnings multiplier that we're going to use in our formula. And after Premier Digital Printing answered all the questions, and we analyzed them, and we might have modified them, they scored pretty high. They ended up with an excess earnings multiplier of 4.57. Now, we're going to show you how we valued Premier Digital. First of all, we have already determined that it has $998,000. We also calculated, based on looking at their financial statements, extracting out their salary and net profit and country club memberships and a lot of miscellaneous things, that his total owner's compensation was $138,320. We calculated a fair market salary for that company based on the $998,000, and we used our formula, $14,000 plus 4% of sales times 1.18, and we determined that the fair market salary for this company would be for this owner, $63,629. Now, in the next stage, as we move on, we need to know, remember, we need to know what the value of the net assets are for two reasons. One, you're selling the net assets, but number two, we're also subtracting 10% of those net assets from our final excess earnings calculation. So as you can see, we've got the net assets figure in here of $213,190, and we've calculated 10% of that is $21,319. I know the screen is getting a little bit jumbled here, but we end up with a total number of $53,375 for excess earnings. We've already told you that the multiplier is 4.57. So this valuation says we take 4.57 times the excess earnings, then we add that back to the value of our net assets, and we end up with a total value of this company of $457,116. That means a seller could sell that business for that amount. It would be a fair market price, and a buyer could buy it for that amount and would be assured of being able to pay himself a salary and then generate enough excess earnings based on current performance only to pay you, the seller. And so I want to show you one last thing. I want to show you a real example of the kind of services that I provide in my valuations. As I've probably mentioned before, although quite honestly I don't recall, I've been doing valuations since about 2008, since Larry Hunt and I published Print Shop for Sale. It's now in its second edition, and all the valuations that I've conducted over the past 2 to 3 years, which are well over 100, 150 valuations, I get involved in a lot of situations, some good, some bad. But I want to show you one last thing as far as a real-world valuation that I've conducted recently for a company. Okay, I've mentioned my valuation services, and quite honestly, yes, I am trying to sell valuation services, but only because they are absolutely necessary. You can buy quick Print Shop for Sale, and you can calculate the value of your business on your own. You could pay an appraiser. A typical business appraisal will run $3,000 to $4,000 for an appraisal. Ultimately, however, while that value is good and while you've established a basic value and you know it, what's going to happen sooner rather than later, you're going to want to sell this business. You may be forced to sell it. You may go through a divorce. Your partner may announce that he wants to be bought out or he wants to buy you. Someone may suffer a stroke, and the remaining spouse who's not active in the business is going to need to sell that business. That's probably not the best time to come up with a valuation. Unfortunately, when I'm called in, we're already at the state where somebody has to close the business down. Does it have any value? My wife had a stroke. My partner is trying to buy me out, or I need to buy him out. You won't believe the stories. But anyway, that's probably not the best time. But at that point, you need to bring in an outsider, because you're most likely never going to be able to sell your business based on your calculations alone or what a potential buyer is going to calculate. You probably will need a third party to come in. You can pay $3,000, $4,000, or you can pay under $1,000 for the appraisal services that I offer. Well, that's a commercial, I guess, but in the real world, that's a real statement of facts that only a third party independent appraisal is really going to carry much weight in selling your business. Real quickly, I'm just going to show you a classic business valuation. This is about a 9 or 10 page Excel spreadsheet to which I add a 8 to 10 page narrative and explaining what a business is worth. Now, I don't have individual slides for this. We may cut to them in the final video, but I want to show you that basically we've got the title sheet, no big deal. We've got the questionnaire, which we've already mentioned before, first page, second page. We've got his scores, the individual scores. In this case, it was 4.57. In fact, that's for Premier Digital. Show you something that we've just recently added, which one franchise told me was very, very helpful. This is the first of 2 pages of a profit and loss statement, and you'll notice the colored columns over here on the side. So we have his cost of goods percentage, we have his payroll percentage, we have his overhead percentage, and what we've done is we've added 3 columns. We've added the industry average here in yellow, we've added the top 25% performers, and in the red, the bottom 25%. So it's real easy for someone to say, wow, I'm really on target there, my ratios are better or they're worse than others in the industry. Ultimately, we end up with on the last page of the profit and loss, we end up with a breakout approximately it looks like this. Now, we'll probably cut in on this, but this is a summary of owner's compensation. It's a total of salary, wages, perks, benefits, health insurance. You'll have to see the slide, just examine it. But basically, we end up with a total number, in this case, of $138,000, which was for Premier Digital. We've got an asset sheet that we have to create every time from scratch. But basically, let me tell you one thing. Let me point out one thing. You can only sell assets that you own. We're talking about selling printing equipment, the copiers. We assume that those things are paid off for. A buyer is not concerned with any of your current, short, or long-term liabilities, nor does he get any of your current assets, like the receivables and cash in the bank. You're going to take care of all that stuff. Now, unfortunately, I will tell you in conclusion on this presentation that there are a lot of owners that we've done valuations for where a business might be worth $4 or $5, maybe $600,000, $1 million in sales. The unfortunate thing is when you go to examine the balance sheet, or when he or she examines the balance sheet, they still owe $300,000, $400,000 on loans, credit cards, long-term, short-term loans. And in fact, after they sell the business for that $600,000, they immediately have to write a check for $400,000 to clear the books. So I encourage you to check your balance sheets very carefully. And once again, we end up in our valuation, we end up with a sheet like this, which is basically the formula, the recast that you just saw just a few minutes ago, but this is a real world. And to that, we may or may not append a note like this or additional notes explaining our valuation, the special circumstances, etc. I hope these two videos, I know they've gone fast and made a little hectic back and forth, but if you go and print out the slides, I think you're going to get a very good lesson on how to value your own business. And if you have any questions, don't hesitate to email me at qkconsult@aol.com. You can also go to the website and download these slides. But with that, I hope this has helped you understand a little bit better how to go about valuing your printing firm. With that, thank you very much, and I hope you've enjoyed the presentation. Thank you.